From Asia, Europe, and the United States, this is CNBC's Worldwide Exchange.
Louisa, hello. Well, early on in the session, exporters got a big helping hand from the stronger dollar. Airlines also did well because of that fall in crude prices, so that helped out sentiment. This, in the end, pushed the MSCI Pan-Asia Index to climb from a two-year low. The Nikkei closed up 1.7%. The Kospi in Korea closed up 0.4%. The Shanghai Composite up 0.3%. Hang Seng was the biggest winner today, up 3.5%. Crude oil prices, well, they were down, but they're now up slightly, tagging a little bit of a gains there after that plunge of more than $6 on Friday. Right now, NYMEX trading up 89 cents, $115.48 a barrel, and Brent up $1.09, $115.01 a barrel. Brian.
Joining us now for some equity strategy is Emily Sanders, CEO at Sanders Financial Management in New York. Emily, thanks for getting up early for us in New York. It's not the question du jour, really. It's the question de moi, I think, when it comes to Fannie and Freddie, because we can't really stop asking the question. I wanted to get your sense of what's going to happen, but more importantly, what will be the impact on the credit markets and the housing sector?
Good morning, Brian. Yes, it's almost understood that the government is going to bail out Fannie and Freddie, and the Housing Act that was signed into law on July 30th sets the stage. Now, some of the provisions of that Housing Act don't actually go into effect until October 1, but with the Fannie and Freddie stock behaving the way it is, teetering close to zero, the market is telling us that the bailout is going to happen sooner than October 1st. So as far as the effect on the credit markets, it's going to have a ripple, perhaps at first a little shock, then relief. And some of the regional banks that hold Fannie Mae preferred stock will probably be under some pressure because those stocks will cut their dividends and will have to write down some of their assets. So probably on the smaller, weaker side of banks, there will be some more failures as predicted. And as far as the U.S. economy, while it will be terrible to increase the deficit even more, it'll create relief that, at least help is on the way. Brokers will have to be regulated and licensed, and some homeowners will be able to refinance their debt for 90% of what it currently is at.
So taxpayers, they foot the bill and the shareholders lose their value. But is this potentially, as you talked about with the failures and the collateral damage, is this finally perhaps the last bottom that we can turn the corner on?
Well, in my opinion, Brian, it's not the last corner, but it's the second to the last corner. The Lehman story that you've been reporting on for weeks now is about to come to a head in the next week or two. And Dick Fuld has been bravely hanging on to the company, and his popularity on Wall Street has deferred, a complete collapse or takeover of Lehman. But the signs are pointing to a hostile takeover, as was reported last week, if not from the Korean bank or Chinese bank, from some well-moneyed circle, and Lehman will have to be broken up and the assets sold off for their true value. So really, that second catharsis after Bear Stearns and perhaps another major bank failure in Europe will then lead the way for the financials to climb out of the hole they're in.
Emily, hi, it's Louisa in London, and that was exactly my point, namely expect one more European bank failure I saw in your notes. I mean, is it really that simple? Is that what we're apt to expect, and what's the time frame?
Well, the financial crisis is anything but simple. It's the perfect storm, the most perfect storm that I've seen since the mid-'70s. So from that standpoint, it's not that simple. But the markets are ruled by human nature and psychology and greed and fear. And in order to have a cathartic sell in the market and to just wash out all the bad excesses that have happened, I believe, a sacrificial lamb is needed. And there are several banks whose names have been batted around in Europe that could turn into that sacrificial lamb after the failure of Northern Rock. So I do believe there'll be one more, perhaps a British or a large continental bank will either fail or be taken over or be nationalized, and then the relief rally will start.
So, Emily, the top place that you'd be putting clients' money at the moment is where?
Well, we like some of the undervalued U.S. stocks. Like we actually considered GE to be a value at these levels because Immelt is shedding the low-growth businesses and going into alternative energy and infrastructure plays. The tech stocks are appealing because they are growing cash flow and have good international exposure and are actually gaining business internationally. And we also like non-financial preferreds. May not be the most sexy investment, but some of them, like, for example, an AT&T preferred are paying 6.75%, which is fantastic in this market, you know, in U.S. dollars. So we see that, you know, we've had like a bear market rally, several of them over the last few weeks, and as the election draws nearer and some of the uncertainty in the U.S. lifts, markets will start coming up to a more normal level. But it doesn't mean we're out of a bear market, just that there will be a relief rally between now and November, December.
Emily, this is Christine here. Speaking of the bear market, what do we need to see for this bear market to be really over?
Well, it's going to be a while, Christine. I think that housing is the linchpin of the bear market, and until housing prices really worldwide stabilize, because the downward spiral in U.S. housing prices has now spread to Europe, as you well know, and perhaps not Asia where you are, but it's really becoming a global issue. And so once housing prices stabilize, which they seem to be, if you look at how inventory of unsold homes is just starting to dip down a little, the end may be coming in 2009 sometime, perhaps mid-2009. Some say 2010, but I think once the housing bill kicks in and, you know, the U.S. foreclosures start, they actually are increasing at a declining rate. You know, there will be an end in sight, but there's still going to be further, slower declines in housing prices.
All right, Emily, we'll have to leave there. Thank you very much for being with us. Good seeing you. Emily Sanders, CEO at Sanders Financial Management.